Hello, and welcome to Collin Investing, your go-to channel for into-school analysis on finance and investment. I am Collin, and this channel is dedicated to providing you with the information you need to navigate the ever-changing world of markets and investment opportunities. We'll be diving deep into company analyses, exploring market trends, and discussing the forces that shape the financial landscape. So, whether you are a seasoned investor or just starting, join us as we decode the complexities of finance, one insight at a time. All right, let's jump right in. On the 27th of February 2025, President Trump made headlines by announcing increased tariffs on goods from Mexico, Canada, and China. Now, this immediately raises a lot of questions for investors, and that's what I want to unpack for you first. It's crucial to understand who actually pays these tariffs. It's the importer. Think of a company like Amazon bringing in products from China. They're the ones footing the bill, not the Chinese manufacturer directly. This leads to a critical decision point for these businesses. Do they absorb those increased costs, potentially squeezing their profit margins? Or do they pass those costs on to consumers in the form of higher prices? You see that immediate impact on us and our cost of living now. Here is an interesting wrinkle. The US dollar has strengthened significantly at 9% appreciation since the election. This actually acts as a partial buffer against these tariff impacts. A stronger dollar means each dollar buys more, partially offsetting the price increases from the tariffs. It is not enough to offset the impact, however, the appreciation is important. And this is a big but, the real key here is time. How long will these tariffs remain in place? If it's just a month or two, the impact might be relatively minor. Companies can often weather short-term disruptions. However, if these tariffs become a long-term reality, stretching over several months or even quarters, we're likely to see a much more significant hit to corporate profit margins. And that's something that will directly affect stock market valuations. So we've established that the duration of these tariffs is the critical factor, but what are the mechanisms at play here? What actually happens to companies and ultimately the stock market? It's a complex interplay of several factors, all ultimately impacting that crucial bottom line. Profits? First, and most obviously, you have increased import costs. We have already covered that. Companies are paying more for the goods they bring in, as simple as that. But then you've got currency valuation changes. Remember that 9% dollar appreciation? That's not just a statistic. It directly impacts the cost of imports, potentially softening the blow of the tariffs, at least to some degree. We also need to watch for those changes. Beyond that, companies aren't static. They will react. This could involve operational changes like shifting supply chains or seeking alternative sourcing. Or it could mean strategic changes, such as adjusting pricing models or even re-evaluating their entire business model. They will not stand and take the hit, they will change things. And of course, here is the consumer. How will we react to potential price increases? Will we keep spending at the same levels or will we pull back, leading to lower sales for these companies? Consider a situation where every product increases the price. What would you do putting all of this together? One likely scenario is that businesses, particularly in the short term, will choose to absorb at least some of these increased costs. They might do this to maintain market share or avoid alienating customers. However, this directly translates to lower profits. Lower profits, in turn, often lead to lower stock prices as investors reassess the company's value. Now, it's important to note that larger international companies are likely to be the most vulnerable. They're the ones with the most complex supply chains and the greatest exposure to these tariff changes. And pay attention here, it is even companies that don't have a direct manufacturing presence in the affected countries. Canada, Mexico, China could still feel the pinch. Why? Because currency fluctuations can impact the value of their sales in those regions. If they sell a lot of products in Mexico, for example, and the dollar strengthens against the peso, those sales will be worth less when converted back into US dollars. This is another way those currency impacts affect everybody. So, we've talked about the immediate tangible effects, the cost increases, the currency fluctuations, the corporate responses. But let's separate the short-term pain from the potential long-term consequences. It is two very different situations. In the short term, as I've mentioned, the picture is likely to be negative for many businesses. We're almost certainly looking at declining profit margins and consequently pressure on stock prices. This is the immediate fallout from the tariffs, however, and this is where it gets interesting. the long-term impact is far more uncertain. It's shrouded in a lot of volatility and depends on a multitude of factors that are honestly hard to predict. We are in a very fluid situation. Here is one potential, and I emphasize potential upside in the long run. Imagine that, if these tariffs become a persistent issue, some companies might decide to shift their manufacturing operations back to the United States. Think about it. They could avoid the tariffs altogether, simplify their supply chains, and potentially gain some positive PR. This, in theory, could lead to job creation within the US, a potential silver lining to this whole situation. It is not a certainty, but is possible. But let's be realistic. For now, the overall initial impact of these tariffs is likely to be negative, particularly for those larger international businesses that are so heavily reliant on global trade. They are the ones who are going to feel the most immediate impact. From the broader market impacts of tariffs, let's shift our focus to a specific company that's actually defying some of the current economic headwinds: Walmart. And the numbers tell a compelling story in their most recent quarterly earnings. Walmart reported a robust 5.2% growth in sales. But it is even more impressive, their operating income surged by 9.4%. Those are not just good numbers. For a company of Walmart's size, they're exceptional. We are talking of a giant here. What's driving this success? Well, Walmart is gaining market share across the board, and I mean across the board, different countries, different income levels, they're winning everywhere. It is important to note that their transaction counts and unit volumes are up. More people are shopping, and they're buying more stuff. But here is the real kicker: Exxon. It's no longer a side project for Walmart. It's becoming a core part of their business, approaching a staggering 20% of overall sales. Think about that for a moment. A company traditionally known for its brick-and-mortar stores is now a major player online. And perhaps most importantly, they're not just growing their online sales, they're doing it profitably. Walmart has figured out how to make creeping work for them, improving their profit margins in this crucial area. They are learning, adapting, and improving, and that is key for any business. So, what's behind this impressive performance? It's not just about low prices anymore. Walmart is undergoing a fundamental shift, and it's paying off. One of the most surprising trends is that they're attracting higher-income shoppers. We're talking about households earning over $100,000 a year. This challenges the old perception of Walmart as just a discount retailer. They are now for everybody. How are they doing it? Two main factors. First, they've significantly improved their product assortment. This is especially true in the grocery category, which has become a major growth driver. People want quality, and Walmart is delivering second. And this is crucial in today's world. It's all about convenience. Walmart has fully embraced online shopping, offering seamless pickup and delivery options. They've made it easy for busy people, regardless of their income, to get what they need when they need it. You do not need to go to the store anymore if you don't want to. Everything is at the tip of your fingers. Now, all of this transformation is reflected in Walmart's valuation. The stock is currently trading at a forward price-to-earnings ratio of 32.7. That's a premium valuation, significantly higher than what Walmart used to command. It reflects the market's confidence in their new strategy. It is a vote of confidence from the investors, and it's not just about growth, it's about profitable growth. Walmart is actually growing its profits faster than its sales, and they're actively investing to expand those higher-man businesses even further. They are delivering at all fronts. This to me signals a company that's not just riding a wave but actively shaping its future. Let's continue with our analysis. And now we will focus into a different company, but one that is also a key player in the tech world, Twilio. They've recently made some significant moves that are worth discussing, particularly regarding their business in China and their strategy around artificial intelligence. First, the big news. Twilio has finalized long-term license renewals with two key Chinese smartphone manufacturers. This is incredibly important, and I'll tell you why. You see, Chinese phone makers are rapidly gaining market share in China, a massive market, largely at the expense of Apple. This should ring a bell, and as many of you probably know, Apple has been in the process of transitioning away from using Twilio's chips. This move by the Chinese manufacturers is a big win for Twilio, helping to offset the potential revenue loss from Apple's shift. It's a strategic cushion, if you will. Although losing Apple is not ideal, having this deal is a great win now. Despite this positive development, Twilio is projecting that its FY 25 revenues in the QTL segment, that's their technology licensing division, will be essentially flat consistent with 2024. So, while the China deal is good news, it's not expected to drive significant growth in that specific area, at least not immediately. It will stabilize things, but here is where it gets really interesting. We're seeing a major shift in the world of AI, and it directly benefits Dwegode. The trend is moving away from relying solely on cloud computing for AI processing. Instead, more and more of that processing power is being built directly into device. Your tablets, your tablets, your laptops, and that's where Dwegode excels. This shift towards enveloping AI has profound implications for Dwegode, because, quite simply, it means we need more powerful devices, and more powerful devices translate to a direct win for the company. Think about it. To handle these complex AI tasks locally, your phone, tablet, or computer needs significantly upgraded processing capabilities. This translates to two key benefits for Dwegode. First, an increased quantity of sales. More devices will need their chips. And second, higher average selling prices. They won't just be selling more chips. They'll be selling their premium, higher performance chips to meet the demands of embedded AI. More and better, and this isn't just theoretical. We're already seeing it in consumer behavior. People actively choosing premium stamps, tablets, and computers. They are not just buying the basic things. They want the enhanced capabilities that AI offers, and they're willing to pay for it. They want the latest and the best. Now, here is a seemingly contradictory point, but it actually highlights Dwegode's strength. The overall asset market investing, meaning the total number of staff kits and similar devices sold, is expected to be pretty stagnant. We're talking flat to, at best, low single-digit growth, something like 0 to 3%. It is not impressive at first sight, but, and this is crucial, within that flat market, Dwegode is projecting double-digit growth in its revenue in that category. How? Because even if the total number of devices sold isn't exploding, the value of the devices that are being sold is increasing, driven by this demand for on-device AI. People are upgrading, choosing premium, and that benefits Dwegode enormously. And that brings us to the end of today's deep dive into the markets, Walmart's resilience, and Dwegode's strategic positioning in the evolving world of AI. I hope you found this analysis useful and helpful as you navigate your own investment journey. If you did enjoy this video, please take a moment to hit that like button and subscribe to Collin Investing. It really helps the channel grow and allows me to continue bringing you this kind of content. For those of you who want to go even deeper, consider joining our channel membership. You'll get access to exclusive content, including spreadsheets with my stock ratings and discounted cash flow valuations, early access to videos, and priority response to your comments. It's a great way to support the channel and get even more involved. I've also included links in the description below to some resources that I think you might find valuable, including information on my investing framework and some recommended stock picks. Finally, I'd love to hear from you. What are your thoughts on the topics we covered today? Do you have any questions about tariffs, Walmart, Dwegode, or anything else related to finance and investing? Share your thoughts and questions in the comments section below. I read every single one, and I'll do my best to respond. Let's continue to grow and learn together.